Good morning, good afternoon, good evening, everyone. Thank you for tuning in today. My name is Peter Zetterli, and I lead CGAP's work on future of banking. I think most of us have the sense that banking is changing, driven by new technologies, new business models, new players in financial services. It seems fairly clearly intuitive that the financial sector will look different 10 years from now. What's less clear is whether poor people will benefit from that change. CGAP has been working with its partners for the last few years to move toward an answer to that question, to sort of cut through all the noise and all the hype around the fintech space in particular, and understand where financial services are really headed, identify any genuinely new business models and significant trends that we think show promise for reaching the underbanked, and to reflect on what the implications will be for financial inclusion, for the sector, for the stakeholders, the incumbents, regulators, and so forth. We've written a lot about this that you can download at cgap.org/fintech. So if you haven't checked that out already, please do after the session, of course. In short, we see a number of reasons why what's happening in financial services can be good for financial inclusion. The problem is that there haven't been any really good data on whether that's actually happening. It's such a new and fast-moving space that research has had a hard time keeping up. So we decided to undertake our own research to explore this by interviewing customers of some of the most innovative companies in financial services today. And the session today aims to share out some of our findings from that work and to talk about them with some of the companies ourselves, because we have a great panel of people with us today. Very pleased to have Rachel Freeman, who's Chief Growth Officer at Timebank, the leading digital bank in South Africa, now also expanding to Asia. We have Natasha Jethanandani, who is co-founder and CTO at Kaleidofin, which is one of the most exciting fintechs in India. We have Tom Adams, who's co-founder and chief strategy officer at 60 Decibels, which is a global social impact measurement company that implemented our research. And we have my own colleague, Nisha Singh, who is technical lead for gender transformative solutions at FinEquity, which is a global community of people working on women's financial inclusion. We're going to run this pretty much like a traditional panel discussion. I'm going to kick us off by talking briefly about how we think banking is changing, why that matters for financial inclusion. Then I will tell you about the customer research that we've just conducted, after which we'll have a conversation with the panel. And I plan to organize that around three key questions. Can and do the new digitally native business models expand financial access? Do customers see genuine value in the services that they're being offered in this way? And third, are women and men seeing similar benefits in terms of access and value from these services? If you want to post questions, please put them in the Q&A part of the interface. We will try to answer them along the way. If we have time, I will also post some of them in the last part of the session. And with that, let's get started. And I was thinking that instead of me droning on, we would start with a short clip that explains how we see financial services evolving and what that means for low-income people.
Technology is changing banking at every level, potentially transforming how low-income people and businesses engage with the financial system. Like Farida. Farida runs a small clothing business in Jakarta, Indonesia. She uses a social media app to market her products. She also has a mobile money account that she uses to receive payments, pay suppliers, and buy airtime. However, she can't get a loan to expand her business or sign up for a savings account to pay for her daughter's schooling. Many financial services are just too expensive and hard to access. Farida's situation isn't unique. Hundreds of millions of people worldwide live with similar circumstances every day. That may be about to change. Historically, even people with a bank account tended to only use a single provider that offered them a limited menu of its own products. Thanks to new technologies, there has been an explosion in fintechs that specialize in offering better versions of many services. As a result, people can choose from a range of providers and assemble a suite of products to meet their needs. This unbundling of financial services is putting the custom back in customer. But new technology isn't just giving people more options. It's also changing how financial services are made. Banks used to do everything themselves. Today, they can stitch together the best solutions from an array of fintechs that are focused on solving a specific problem better than anybody else. And it isn't just banks. Fintech solutions can be embedded into any company and reassembled to meet the needs of its customers. Thanks to all these advances, Farida can buy more fabric with working capital from a fintech. She can also save for her daughter's education with the savings account she obtained through her mobile wallet. The payments and delivery services embedded in her social media app can help her grow sales. And she can upgrade her sewing machine with asset financing secured against her digital income. These advances create new risks that need to be managed by regulators, businesses, and consumers alike. But they can also result in banking that offers lower costs, greater access, better products, and improved experiences for customers, including low-income customers. Whether these benefits are realized will depend on the choices made by businesses and regulators. To learn more and stay informed, visit cgap.org/fintech.
Ultimately, we see the market structure itself as unbundling into four broad layers: a balance sheet layer with banking license, the risk management, the provision of capital, product layer, a customer relationship layer, and a distribution layer. Offering banking used to mean building all of these things yourself within the company, but new technology, new business models are enabling the separation and specialization across these layers, and economic pressures are then pushing things in that direction, because different players have different strengths across these layers, and unbundling lets them make different business model choices across each of the four layers. And that in turn is leading to the emergence of entirely new business models in financial services. And CGAP has studied those and written extensively about what those models are. And we have some excellent examples of that with us in the room today. So let's take Timebank to start. Tyme is the leading fully digital retail bank in South Africa. They launched in 2018 and have grown to almost 5 million clients in just those 4 years. They have a fairly recognizable retail banking business model. So the product offering revenue model, not too different from traditional banks, but they have a very different operational model. The tech stack is cutting edge, cloud native, built for flexibility through APIs and microservices and so forth. In terms of product development, they run more like a tech company than a bank. And most importantly, they are completely branchless. So like traditional banks, they operate at the balance sheet product and customer relationship layer, but they take a very different approach to the distribution layer, where instead of building and staffing branches, they partner with some of the biggest grocery store chains in South Africa, which gives them a network of thousands of physical locations across the country, but they don't need to spend the money building and operating those. And the grocery chains don't incur many extra costs either, because they were already running those stores. Instead, Timebank has built its own digital kiosk where customers can perform any number of actions. You can do fully paperless registration and onboarding. You can even get your first bank card printed right there on the spot with your name and everything on it. And to make it as easy as possible, Tyme is a person on site to assist people with the kiosk if they need it. So superficially, Timebank looks like a traditional bank in many ways, but this model completely changes the economics for delivering banking services. And that lets Timebank offer pricing that is 65% lower than the market average in South Africa, and even 40% lower than the next cheapest bank, which is very significant. Our research with them showed very clearly how important that price difference is for low-income users. Another example that we have with us today is Kaleidofin. They are a fintech startup focused on using technology to address financial inclusion. They focus primarily on underbanked, low-income women. In our framework, Kaleidofin sits primarily at the product layer. They use a combination of deep customer understanding and sophisticated technology to build entirely new kinds of financial offerings for customers that blend savings, credit, and insurance in ways that map to customer needs rather than to traditional product categories. But to build those offerings, Kaleidofin partners with regulated banks and insurers on the back end. They bring the licenses, the compliance, the balance sheets, and Kaleidofin uses those components to build its offerings. For distribution and customer relationships, Kaleidofin partners with microfinance institutions, other local financial service providers. They bring the branches, they bring the field staff through which products are marketed, sold, and serviced. Now, Kaleidofin could, of course, apply for its own licenses and build its own distribution networks, but that would take a lot of time and enormous resources. And even then, it's not clear that Kaleidofin has a comparative advantage in those layers. So why spend all that time, money, effort building something where you don't necessarily have an advantage? A better route to scale and profitability is to partner with players who already have those things. Chances are they might be better at it, but more importantly, they've already invested the time and the resources to build them. So the marginal cost to them of allowing Kaleidofin to leverage on them is quite low. The third company we did research with is Grab. And for them, it's in some ways the same story, but from the other end. So Grab is one of the most successful super apps in Southeast Asia. They started in ride hailing. They moved quickly into delivery of food, groceries, packages. And from there, they've grown the scope into a range of domains, not least of which is financial services. Now they offer a wide range of payments, lending, and insurance products to their clients. They have enormous assets in the customer relationship and distribution layers. They have 28 million customers across 8 markets. They have a distribution network of several million drivers and merchants. They started with payments early on, but has since moved into a broad range of different services. And as they've done that, they've partnered with fintechs who provide sophisticated product and technology solutions, and with banks and insurers who bring licensing, underwriting, and balance sheet and so forth. And we had a conversation with them last week. But so here we have 3 pretty different types of companies that all exemplify this shift towards a more unbundled market structure for financial services. Of course, these are stylized pictures that I'm presenting, and you could have any kind of objections on nitty-gritty details of it. But on the whole, we think this represents well the greater shift that is happening in financial services in this moment. And we think this shift can help to overcome barriers to financial inclusion in all 4 key dimensions. It can help cut costs through cheaper customer acquisition, distribution, lower cost risk assessment. It can help expand access through greater eligibility, affordability, and a shorter distance, both digitally and physically, to the client. It can help improve product fit through products that are more diverse, more relevant to the context in which they're offered, more tailored to different users. And it can provide better experiences through simpler and smarter products that are easier to understand and to use. Of course, all this speaks to potential, and what businesses choose to do with that potential is up to them. Some of this has been hard to research empirically because the space is so new, which is why we have done our own research with these companies, and that's what we're going to be sharing and talking about in this session. So we wanted to hear from customers directly how they feel about these services. Are they getting access to things they couldn't access before? Is it improving their ability to manage their finances? Is it contributing to greater well-being? And so forth. So we worked with 60 Decibels to interview customers, over 1,500 customers of Timebank and Grab and Kaleidofin. 60 Decibels is an impact measurement company that specializes on lean data methodology, using mobile interviews to do large-scale end-user research, which is why we're able to get such a large sample across multiple countries to explore these questions. So now we're going to dig into the findings from that research with the panel. I'm going to start by sharing out some of the high-level findings from the first part of our conversation, which is about financial access. So what we wanted to understand here was, can and do these businesses and these business models expand financial access? First of all, are they serving low-income users? Are they enabling people to use financial services that they couldn't access before? And how do those services compare with the alternatives that people may or may not have available to them in the market? So on the first question of who these companies are serving, the results are pretty varied. Looking at poverty, 3/4 of Kaleidofin customers are poor based on the Progress Out of Poverty Index. The same goes for around 1/3 of Timebank customers. Grab doesn't seem to be serving many poor people in either Indonesia or the Philippines, which are the 2 countries and that we have included here. Looking at gender, Kaleidofin also overwhelmingly serves female clients. Well over 80% of customers in our sample were women. Timebank also serves female clients disproportionately. So 2/3 of customers of Timebank in our random sample were women. For the 2 Grab deployments, only around 1/3 of clients were women. So clear differences in sort of gender skew on the customer base. And that customer composition to some extent reflects the goals of each institution. Kaleidofin is explicitly aiming to serve low-income women, and they are. Timebank also has clearly stated objectives around financial inclusion. Grab is more of a general mass market play, aiming to serve as many people as possible without necessarily having a major focus on the poor. And I think these differences are important to bear in mind as we go through the rest of the data, because the customer base that each business serves, of course, will determine whose financial inclusion is being increased to the extent that it is. These numbers might also reflect deeper patterns in the customer base. So female Grab users tend to be consumers, we noted, whereas Grab drivers in these countries are nearly all men. And that has implications for what services they're getting access to, since the offerings are different for different user groups. Now let's look at the question of whether financial access is being increased. So we ask customers, is this the first time you have access to the financial services that you are getting through these companies? And would it be difficult for you to find a good alternative to this company? And it's clear that a significant share of customers for all companies say this is the first time they're accessing these kinds of services. For Kaleidofin, it's as high as 90%, which is just outstanding. For Grab, it's a little below half, which is still a very significant number. So half of Grab users almost in those two countries are saying the services they're getting are things that they're accessing for the first time through Grab, which paints, I think, a clear picture of how powerful these models can be in expanding financial access. The outlier is Timebank, where the number is just 1 in 10. But the reason for that is South Africa is unusually highly banked, even among lower income segments. There's been a big push on no-frills accounts to receive government benefits and so forth. So that means a lot of people have had bank accounts in the past. But are those accounts useful? If we look at how many people say it would be difficult to find a better alternative, the picture changes dramatically, not least for Timebank, where despite being previously banked, 2/3 of Tyme users say they could not easily find an alternative that matches up with Tyme. So they definitely have access to other banks, but clearly Tyme is offering something better. For the other companies, the figures tracks pretty closely to the numbers for first access, which bolsters the sense that those clients were previously financially underserved. So to me, the takeaway from this first set of data is simple. These companies are clearly expanding access to financial services, and moreover, customers broadly think they are delivering better services than what is otherwise available to them in the market. So I want to turn now to our panel for reactions and discussion around these numbers. Both Timebank and Kaleidofin come across very favorably on expanding financial access. So I want to hear a little bit more about what is different about your models that you think enables this successful outreach to underserved customers, which are the key factors. And I thought we would hear first from Rachel Freeman at Timebank.
Well, thank you, Peter. And we were really happy to be able to participate in the survey. CGAP had looked at digital bank models and compared us with Union Bank and some of the other in the Philippines, some other models. And then for them to come back and then say they wanted to do the study to demonstrate about whether we were actually serving the underserved. It was really great, though we ourselves knew that because we track our data very closely. And so we know what not only are we serving poor people, but our customers have gotten significantly poorer across the period of COVID. And we, have been watching this the whole time. Our model is really unique in terms of digital banks. And when we launched Timebank in South Africa, and for the year after that, whenever we would talk to different groups about expanding into Asia, and I'm actually in Singapore and part of the expansion into Asia that Tyme is doing, then people would say, no, we really want just digital. You're not really digital. We don't like this hybrid model. But we actually believe that our hybrid model works, and that we have our digital kiosks. You saw a picture of this. And the kiosks are in the grocery stores in South Africa, which meant that on day one, when we opened, we had national footprint in that we use the grocery stores really as, you would say, branches, where first through the kiosk, you can open an account in between 3 and 5 minutes, get a personalized debit card, and we have ambassadors that instruct you on how to use the account and how to actually download the app, how to do different things. And we know that this actually works. 80% of our customers come in through the kiosk. But the other part of the grocery stores that's quite important is that you can do cash in, cash out transactions at the till point. So after you open the account, after the ambassador has kind of shown you how to download the app, then the ambassador will take you over and help you do that first transaction at the till point, so that our customers start and are automatic, kind of immediately active. And that's a big difference that we see, because we believe, and I think people have heard Tyme say this a lot, we don't believe people wake up in the morning and say, let's go open a bank account. So you really need to manufacture that type of interaction. And the reason that we chose to do this at grocery stores, one, is that's where people go. They really trust their grocery store. It's one of the trusted brands. Pick and Pay, Boxer, that is the most trusted brand in South Africa. But also you're going there to make a transaction. So you're already thinking about money. You're thinking and you're in the mood and kind of mindset to actually be open to a bank account. And we believe it's really important to actually come up with that first interaction and manufacture that right in order to reach people, and in particular, the underserved. Our kiosks are national, so they're in rural areas. The study that CGAP showed that we are quite relevant in rural areas. In South Africa, the poor are more in rural areas. It's youth, it's women, and all these groups are actually significantly helped by our approach through the grocery stores with the ambassadors, the kiosk, and the easy cash in, cash out.
Thanks so much, Rachel. And for those who are interested, we've written up a special piece on Timebank that's on our website. If people want to see more of the data that we have from Timebank, which was quite fascinating, you can go find it there. I want to turn it over to Natasha to hear from Kaleidofin. Same question. What do you think is different about your model that is enabling these quite impressive numbers on your outreach to underbanked clients and the ability of your business to serve them?
Thanks, Peter, and thanks for having us here as well as for doing the study. I think, as Rachel said, we're also quite thankful that this came through, and it's great to see real data validate sort of what we're trying to do as a very core mission. I think in terms of what is unique about our model that allows us to do this, I think there are a few things. I think one is we really believe in tying our financial offerings to the goals that the customer already has. So every one of our conversations starts with what is the goal of a customer, whether it is to send their children to college, whether it is to get somebody married in the house, whether it is to buy a two-wheeler, whether it is to buy a new cow to expand their current agricultural business. I think, it starts there. And I think then it's all about sort of personalizing and suggesting a solution to that customer that ties into that goal, that understands the risk of that customer. So behind that very simple conversation, there is, a lot of work we've put in to try and, understand the customer's current situation, their risk profile, and then recommend the right solution. I think the other thing is we try to just provide a solution in one go. We try not to be piecemeal, many otherwise, you sort of financial providers tend to be piecemeal. I offer insurance, I offer investments, I offer loans, and this customer really doesn't have the time or the space to really be going out and looking for these piecemeal. And so to be able to really customize it to what they need, whether it's a combination at that moment to start with savings and have access to emergency credit, or whether it is to start with a loan and over time building a savings habit. And so I think that really makes a difference. I think also what Rachel said resonates with us also. We strongly believe in a tech and touch model. We feel the trust really comes from having a trusted person who you already know, and in our case that's very often a financial institution partner who the customer is already working with, but who may not provide these services. We find this also works very interestingly in credit. So it's not just a solutions for savings, but we also have been able to use a lot of data-driven, data science approaches to expand the kind of access to credit customers have. So to go from, say, a microfinance group loan to slowly be able to graduate to an individual personal loan that really addresses the need that I might have as in my household, in my business right now, really has also been something we've been able to provide. And I think we've now enabled over 60 billion rupees of credit access in India, which is a large amount, and we've been able to do that with this data. So I think overall, I would say, both the solutions approach, goal-based, as well as using data to really enable this customer to access products that they couldn't otherwise access really makes this unique.
Thanks, Natasha. So what comes through clearly in both of your answers is exactly this combination of high tech and high touch, right? Which I think is what a lot of financial service providers have been struggling with. And each of you has a very innovative take on that problem, which I think is partly why this conversation is so fascinating. So I want to pass it back to you, Rachel, to hear a bit more about that, how you came up with that high tech, high touch model, how it's been working out. And as Tyme is expanding to Asia, do you expect to use the same distribution model, or is that a very South Africa specific phenomenon? So a simple point in case is that South Africa has these big retail chains. If in large parts of Africa, if you try to do the same thing, there's not a lot of retail chains that have that footprint. Asia might be different, but it'd be interesting to hear about whether you expect to use that same distribution model in other markets, or you will take more sort of locally contextual approaches to things, and if so, sort of how you think about that.
Yeah, well, actually, I mean, one of the reasons that we picked going to the Philippines is that there's quite an interesting phenomenon in the Philippines where there are large conglomerates, and most of them have a retail chain and a bank that are paired together. So that fit very well for our model. And we are working with the Go Conway family with Tyme. So Tyme is our bank in the Philippines. We have a digital banking license, which is a new type of license. We'll be launching in third quarter of 2022. So we're in intense build phase right now. And we partnered with the Go Conways because one of their very large retail footprint, they have grocery stores, they have a major footprint in pharmacies, they have malls, they have department stores. And so it was the breadth of the retail that was quite interesting for us. Also, they have a smaller bank as compared to some of the other banks in the country called Robinson's Bank, which meant that they knew and understood the regulatory environment and how to work with the regulator in the Philippines. And so for that reason, they were quite attractive to us. And we're really lucky because they actually liked us too. So we formed a joint venture with them and then together secured the license. We are in the process of building our kiosks for the Philippines right now. We had to make some structural changes. South Africans are quite tall, so then we had to change that for Asia. But also South Africa is a dry climate. The Philippines has lots of floods, so we had to change the kiosk for that part as well. So there's things, and actually now that we have more kind of operations in Asia, we're actually changed from manufacturing the kiosks in South Africa, where we did it in our own factory. We're now actually manufacturing them in Taiwan. We're going to have a number of the same approach that we did, but it's going to be much broader. And actually in South Africa, we are rolling out the kiosk now in fashion retail stores as well as our grocery stores. So we're taking some of the learnings from the Philippines and now bringing it back to South Africa as well.
Excellent. That's lovely to hear. And I love how the local contextualization is less about sort of a whole new model, and it's more about height adjustment of the device and waterproofing the device. What's fascinating about Tyme, of course, is that you guys have literally designed these things from scratch and built them from scratch in South Africa, as you were saying, which is in itself is just a wonderful story. I want to pass it over to Tom, who led our research and of course has done research on hundreds of other financial service providers across the world asking the same exact questions. Tom, would you say there are patterns in what kinds of businesses are more versus less successful in reaching the underbanked?
Yes, Peter, the same exact questions over and over and over again. But they get, in some ways they get more and more interesting the more we ask them of more organizations. Because you start to build, when we see 3 companies, it's very interesting. If we'd had one of those sets of information for just one of these companies and you've been doing the presentation, we'd all been scratching our heads and saying, well, is this good or is this less good performance? And so when we start to see across many organizations, it really starts to come alive. I will say, one caveat though is that almost 3/4 of the data we've collected so far across these hundreds of organizations have been in microfinance or asset financing organizations. So, your description of these new fintechs, it's actually a slightly newer area, these FSPs, a slightly newer area for us too. So we're cautious of making too many generalizations. Looking across those sort of 3 data points that you were covering in this part of the presentation, what we do see is that FSPs offering primary lending products are slightly more inclusive than those that have other offerings. Now, not huge, because 3 percentage points or so, but like everyone gets very, very excited about small basis points differences in financial performance, and actually we want to see a similar sort of excitement about even fairly small differences in social performance. The other thing is, even though those are averages, we also see, and as you've seen in this presentation, that performance can be way over the map. So like sort of classic of counting, looking at impact, and social performance by scale metrics of how many people reached, it hides so much. And even over time, when we work with customers on a repeat basis, their performance can be good 1 year and can be maintained or can improve or go down. And so actually organizations that are collecting data over again are also getting much more nuance about their performance against peers and also over time. Some other just small things we notice, FSPs with transactions and payments are most likely to be reaching first-time users compared to the rest of FSPs. Perhaps unsurprisingly, those that kind of really see themselves as challenger banks and are both identifying themselves as challenger banks and trying to go into markets where there are maybe fewer alternatives, are actually reaching clients with fewer good alternatives. And then the organizations that are reaching those that are more excluded, are poorer by a lower income, are often microfinance organizations that have an explicit raison d'etre, explicit target to reach underserved population as part of their mission. So those are a few of the things we're seeing.
Excellent. Thanks, Tom. And we look forward to talking again a year or two out when you guys have done more fintechs and neobanks. I think that sample that you're benchmarking against will only get more interesting over time, of course. I want to switch over to our next question. So I'm going to fire up the slides one more time and talk about whether customers see real value in the services that they're accessing through these companies. So we wanted to ask if the services are helping them manage their finances, achieve goals, reduce their financial stress, and ultimately improve their overall quality of life. First, we asked a series of questions about financial control. So do customers feel that their savings balances are increasing thanks to these services? Has it made it easier for them to raise money in an emergency? And has their overall ability to manage their finances improved thanks to the services that they're getting access to from these companies? And when it comes to savings balances, a clear majority of customers say that their balances have indeed improved as a result of getting this access. 3/4 of customers at both Kaleidofin and Timebank say so. More than half of Grab customers in the Philippines say so. For the ability to raise funds in an emergency, the picture is a bit more mixed. For Kaleidofin and Grab Philippines, a majority of customers say it is easier for them to raise emergency funds as a result of this. For Timebank and Grab Indonesia, it's a little bit less, between 1/3 and 1/4 respectively. But on the overall ability to manage their finances, again, a very clear majority of customers say that this has improved as a result of these services. So for 3 of these companies, between 2/3 and 80% of customers say that their ability to manage their finances has improved thanks to the financial services that they're getting access to, which to me is a very, very powerful result. The outlier is Grab Indonesia, where customers are reporting lower scores across the board. But even there, over 1/3 of customers say that their ability to manage their finances has improved thanks to the services that they're getting from Grab Indonesia, which is not a bad result. But of course, very impressive for the other companies. Between 2/3 and 80% of customers think their ability to manage their finances has improved. And anyone who understands the economics of low-income customers knows how important that response is. We also ask customers a series of questions about their financial health, their overall well-being. First, whether their ability to meet their main financial goal has improved as a result. Second, if it's helping to reduce their financial stress levels. And third, whether their overall quality of life has improved as a result of these services. For meeting the main financial goal, again, a fairly solid majority of customers say their ability to meet their financial goal has improved. For Timebank, full 2/3. For Kaleidofin and Grab Philippines, it's just over half. Grab Indonesia, a little bit less again. For the reduction in financial stress levels, the figures are fairly similar. Kaleidofin around 2/3, Timebank and Grab Philippines just over half. So both of these metrics, 3 of our 4 companies here are coming in at between half and 2/3, which is quite impressive. But what is perhaps the most important variable is also the one where we see the most impressive figures. So when we ask, has your quality of life improved as a result of getting access to these services, there is a very clear majority across all 4 companies. For Grab Philippines, more than 90%. For Kaleidofin, Timebank, it's around 3/4. And even for Grab Indonesia, over half of customers say their quality of life has improved. So to me, these are very impressive numbers. Granted, there's some variation across companies. There seems to be something going on with Grab Indonesia that one could try to get into. But broadly speaking, clear majorities of customers across all companies say their financial health, their financial control, their general well-being has improved thanks to the financial services that they're getting access to. So I want to turn back to the panel again and hear how you all see these findings, whether they resonate with how you see yourselves and what you're hearing from your customers. And I thought we would start with Natasha and then over to Rachel.
Yeah, I would say for me, looking at these findings was actually one of the most key areas that came across in the study. You know, it's the true, how does the customer ultimately respond to what, services are being provided. And I think it was, really good to see that both the savings balances improved, and they also saw their ability to access emergency funds improve significantly. And as a neobank, that combination of providing access to both savings and credit is, just very, very core to what we're trying to do. And I think also we believe very strongly in that savings and credit journey side by side, and really enabling the customer to do, start in either one, but make sure that their overall financial journey includes both. I think it was great to see. I think it was also, would love to understand more why certain customers still feel like, the financial distress hasn't reduced. And so always more to do here, right, in terms of going back and evaluating the data and seeing, what can be done. And I know we are also towards the start of our journey. There's a long way to go. We're learning a lot also in terms of how do we, start at the doorstep of the customer where they really have a trusted assistant, but how do we over time migrate that to a more digitally driven customer engagement journey with the customer, where they're able to access information via their mobile phones, via an app, via IVR, and really go self-service. And I think that's a big challenge for us given our segment. So I think that's going to be again a next round of making sure we're able to do that journey, but still keep these numbers at the levels where the customers really feel that value. Yeah.
Excellent. Thanks so much for that. Over to you, Rachel. Same question. How does this resonate with you? How you think about yourselves, what you're hearing from customers?
Yeah, but we found it really interesting, the feedback, and I had shared with you earlier that some of the feedback we gotten from the report with 66 decibels was on customer service and the call center, and we made clear adjustments based on the data and have seen a big improvement in some of these different categories since then. We track a number of this through our Net Promoter Score, which is our main measurement that we use for ourselves, and it aligns very closely to this. Some of the other things that I think came out of the study for us was, thinking of some of new segments that we hadn't been in before. And one is the grant. So we had just started to think about grant recipients when we had the study done. And since that, and we were looking as to considering these numbers, how come we didn't have all of the grant recipients from the government grant recipients? We realized that it was because the forms had to be printed out and signed in wet signature, actually, for the bank accounts for the grant recipients. And so then we worked with that administration, they're called SASA grants, to actually automate the process. And then we've actually taken some of our ambassadors and sent them to the offices and installed. So we took the kiosk model, but we couldn't put kiosks in all of those places. So we built from that model, the kiosk model, onto tablets, took the tablets into the SASA grant offices, and then started to onboard these new customers, which are at a level even kind of below in some ways what we had before. So from that, we've actually won a tender and now are building out this category. And I think part of our interest in building this out came from some of the results from the survey. I mean, the other piece about emergency fund, I think is interesting, and what Natasha said, to date, Tyme is really known for one, it's really interesting savings programs as well as transactional banking. And the fact that you can buy a whole host of things in the app, like anything that can be sold digitally, whether vouchers, bus tickets, plane tickets, gaming, all of this you can buy. We've have a lot of insurance products now. We've launched Tyme Health all in the app, but we have not been as focused on as much credit. And that's an area that we will be growing into more. But I do think that we can see from the study, some of the things that our customers need are in the credit area. And that's why, we were going to be launching credit, and we would have, if not for, I think, COVID, built a very strong book. But somewhat we had to rethink how to do that, came out with a buy now, pay later product. But that's quite targeted. But now this is one of our big focus in South Africa is on the credit side.
Thanks, Rachel. Yeah, to me, that's part of what's so impressive about these numbers is that you've been managing to meet your customer needs to the degree that you have, while still not really offering a credit product, which tends to be, both from the business point of view and the client point of view, a central product. Yeah. So I think it's going to be exciting to see how this evolves as you guys build out your credit offering as well. I want to turn back to Natasha briefly to ask this question of customer value and what customers want. I think Kaleidofin has a very unique approach to sort of product design, and you alluded to that a little bit earlier on how you think about products and your customer needs. So I wondered if you could elaborate a little bit more on that process and how you sort of approach this question of creating value for products and for customers, and what that means for the way you design your products.
Sure, I'll absolutely happy to talk about how we approach this. So, like I mentioned earlier, I think we feel the conversation with a customer starts best with talking about their real life goals, and then just literally working with them to understand what are what's their capacity to save, say, on a monthly basis, what are their needs in terms of credit, and we ask a series of small, not too many, usually we try and keep it to 10 to 15 questions to really understand the customer a bit better. We also try and through various other sources, including collecting information about KYC, try to understand more about this customer. And really, what we've done with that is really built a persona engine, which tries to understand the customer on various different fronts. What is sort of their asset situation, what is their liability situation, what is their family fragility looking like, with a combination of these factors, try and understand the risk profile of the customer. I think when it comes to in a certain set of situations where we also additionally have access to any past credit data, we're able to further create a much even more deeper recommendation engine, which we call chi-score, which is able to create essentially a credit score for this customer. And it's not that these customers don't have a credit score, but it is so basic and so underutilized due to that, because it's usually low, and very few banks or financial institutions in India will provide any kind of credit to this customer basis that score. So the idea is to weave through those layers and really use the information we have about the customer to both identify their persona, also try and see if we can have a chi-score created for them, and then really recommend the right solution basis that sort of behind the scenes data science driven AI ML based information. But ultimately to the customer, the offering is very intuitive. It's a combination of savings commensurate with what they're able to afford. We keep it very flexible, so we understand that this customer is very, a lot of seasonality in income, a lot of unpredictability, and so nothing about our savings requires them to save, absolutely on schedule. We have a lot of products otherwise, like recurring deposits, which actually can charge fees, or even mutual fund SIPs, which will go into dormant state if you don't save regularly. So we've created a real flexibility on using these third-party products to allow customers to do this at the points that they can. We also build in insurance into this without actually even necessarily asking the customer to choose. We provide that choice in addition on top of it, but basic insurance towards the amount of the goal that they're saving towards, we bundle in. And we also provide the ability of accessing emergency credit, especially in cases where we have some savings behavior. This actually becomes very useful information to underwrite that credit as well. Overall, I think this sort of solution approach, it's a bundle that's provided to the customer in one go. They understand how they interplay together. And from that point on, once they've worked with an agent on that, they're able to then move on and handle this product more independently. And as I mentioned earlier, we gradually transition from a completely assisted mode to a much more self-service mode. We find a lot of customers really connect to this. There's a real, strong intention to save. There are still challenges, as with any startup, any business model that's trying to do something new. Payments is an interesting one. Making payments more accessible is a problem we're really trying to solve as well, because customers cannot travel, cannot take a day off to do that. But overall, I feel like the solution, that's our product design approach, is really to build what the customer needs and to provide it in one go, but also access the pieces that they need at the right moments.
Yeah, I mean, it should really be obvious to all of us, but I love the whole way you're approaching this, and not least the customer facing part, because the customer is not coming to say, oh, I want to buy insurance, or I want to do this,
Yes.
buy this or buy that. I want to have a baby. And you say, okay, we have a maternity product for you that combines several of these elements in a way that makes sense for someone having a baby. And that's because they don't have a desire to buy a financial product. They have a life goal or a problem that they want to address, and your products really speak to that. And I think that's really an amazing, should be self-evident to every financial service provider, but clearly it isn't, and you guys are doing a great job showing them all up. I want to switch tracks. I'm looking at the clock, and we have one more important session that we want to get to, which is about gender. So let me quickly share my screen again and talk about whether women and men are seeing similar access and value, increases in access and value from these services. So we analyzed all the same variables by gender. On the question of whether people were getting their first access to these services through these companies, numbers are fairly even across genders for both companies. So women are the solid bars on the left, men are the dashed bars on the right. You can see that for Kaleidofin and Timebank is very, very even. However, in grab, men report higher figures. In the case of Indonesia, twice as high. So quite a substantial gender gap in the case of Indonesia, where men are more likely to say they're getting their first access through Grab. When it comes to whether people can find a good alternative, the pattern shifts a bit. And interestingly enough, in Indonesia, it's now the opposite, where female clients of Grab in Indonesia are saying they're twice as likely as men to say that they can't easily find a good alternative. So they're less likely to have their first access through Grab, but they're more likely to say that they can't see a good alternative. For the other companies, men mostly score slightly higher, but it's very even. The exception being Timebank, where women maybe come in a smidge higher. Overall, I would say the picture is one of fairly small gender differences, with a notable exception there of Grab Indonesia, where there are clear differences, but they go in opposite directions, so a little hard to interpret. When it comes to financial control on whether these services are expanding people's ability to manage their finances, again, it's fairly even across companies. I would say men are generally more likely to say their ability to manage their finances has improved. That's true of 3 companies. The exception is Timebank, where women are more likely to say that, but both men and women are very high. On whether services are expanding people's ability to meet their main financial goal, again, fairly even across companies. Responses from Timebank and Kaleidofin slightly favor women. The 2 Grab countries both favor men. But the main difference I would say here is Grab Philippines, where there is a very significant gap on both variables. So men are a full third more likely to say that the services are improving their ability to meet their financial goal and improving their ability to manage their finances. Otherwise, the differences are relatively small. And finally, the responses on financial stress levels. There are some gender differences, but no really clear pattern for Kaleidofin. Interestingly enough, men are more likely to say that their financial stress levels are reduced thanks to Kaleidofin, even though Kaleidofin primarily serves a female clientele. For Grab, the numbers are very even. They're different across countries, which is very notable, but similar across genders within each country. And for Timebank, women are more likely to say than men that the services that they're getting access to are helping reduce their financial stress. On the sort of big ticket question of whether services are helping improve people's quality of life, for Kaleidofin and Grab Philippines, men are more likely to say so. For Grab Indonesia, women are a bit more likely to say so. For Timebank, it's an even split. So there are some relatively modest differences, but they go in slightly different directions across countries. So I would say overall, the responses here are pretty even across genders. Both women and men report in impressive numbers that their financial stress is improving, that their quality of life is improving. I think it is very interesting that the female clients of Kaleidofin are still less likely than men to say that their financial stress and their quality of life is improving, even though the organization is very clearly geared towards serving female clients. And I wonder if there's a sort of broader message around underlying socioeconomic gaps that mere access to financial services cannot, instantly help to bridge. But I want to turn back to the panel for the last few minutes and start now with my colleague Nisha, who is a gender specialist. So I want to hear from you, Nisha, whether any of these findings surprise you, or are they in line with what you would expect to see? Any other reflections that jump out at you when you see these numbers?
Thanks, Peter. And sorry, I'm not turning my video on because right as we started, my internet connection dropped and I'm on my phone. I think these findings do surprise me because the narrative has been that, digital business models, fintechs don't do as well in reaching and benefiting women. So it's actually really heartening to see that there are significant, women are being reached and also seeing benefits of it. Yes, there are marginal differences, but I think this is a great starting point. But within this sample, there are differences between, Grab and Tyme and Kaleidofin, and, for the various reasons that both Natasha and Rachel mentioned, these are institutions that are aiming and have from the very beginning thought of women as a target customer. So that is built into how they approach their customers, how the customer journey looks. Whereas in what we've seen more globally in financial, in the financial sector with traditional FSPs or even fintechs is that things products, processes are designed to a default. So the approach is, oh, we're not discriminating against women or gender neutral, which is technically there's no such thing as gender neutral. So if you are designing for a majority, that's often for men who have been using products, for a much longer time. So our defaults are designed to that, and we're leaving women out. In this case, what really struck me was, even though so many women have access through Kaleidofin, they're not seeing the same improvements in quality of life or stress. And what you said about cultural factors really comes into play here, because women's lives are fundamentally shaped by gender norms, what they can do, what choices they can make with the financial services they have, and where do they invest, what do they prioritize. So maybe thinking about that, even if the providers really are focused on creating these improvements in quality of life, then how would they go about doing that, would be a question that I would have.
Well, let's put that question to our fellow panelists, and maybe I'd love to ask Rachel in particular. I think its clearest pattern was Timebank in all of this, where there was a very consistent sort of more favorable figures coming from women than from men. So I'd love to hear if you have any reflections on why that might be, what it is about your model or the way you approach your customers that might be attributing to that.
Yeah, I mean, we have tracked from day zero, right? And we have sex disaggregated data and have been looking at this, and we track all kinds of data by cohorts of by which month you joined as a customer. And then we splice all that data always by gender. So we can really see what's happening with our customers. So, I mean, I do think that the model with the grocery stores and the ambassadors makes a difference, though we have about 70% of our ambassadors are women. However, having a woman ambassador does not actually translate into having more women customers. We've tested that several times and looked at that, and actually there's not a correlation, which also is quite interesting. I think, as we go forward, some of the things that you saw, about this really came from this kind of first launch in the savings area rather than in credit. But we are doing more things now. We're going to be launching soon. So we're going to be significantly expanding our footprint with sole proprietors. So not SMEs, but actually sole proprietors. And we are focusing on two groups, one of which is social sellers. So the film actually about Farida and selling on Instagram and social media, that is our customer. And actually, you could have read the mind of the Tyme people as thinking exactly what we're going to do. We're bringing out a whole host of products that range from kind of how best to sell and kind of payment gateways for that, matching with delivery for social sellers, and then a soft pause on the phone, plus a just kind of SME platform, a non-financial service platform. It's called Tribe. It's a sister company to Tyme, or I'd say a daughter company in some ways to Tyme, which will have education, business tools, and a community aspect. And all of this will actually be for sole proprietors, but all of the different angles with social selling mean that we actually think that they're going to see a lot of women who have side hustles, which is quite common in South Africa, are going to be really attracted to these new products that we're bringing out. And I think we'll continue to see positive signs from the data on women.
Excellent. That's very, very exciting to hear. We only have 2 minutes left, but I wanted to briefly ask Tom whether these findings are in line with what you've seen from other companies when it comes to the gender dimension of things. Across your research, have you learned anything in particular about serving female clients and what works and what doesn't?
I mean, there's similar findings across the samples more broadly, in that we haven't seen hugely disproportionate value placed on these services by men or women. So, at the average level, we're seeing quite similar reported impact from both men and women, but considerable variation across individual companies. And that we don't see huge variation at the average doesn't mean that, that say targeting men and women is equally impactful. I'd rather like flip it around and say, actually, it's not that these services are on average disproportionately meeting the needs of one gender more than another, which is quite a good news story. We also see a lot of performance in terms of reaching men and women, and I think when we then get behind those numbers, there's quite often the reasons why people are or not are structural. Have you tailored requirements to sign up to, so that you don't need both men and women as co-signers? There are some clear barriers in terms of reliance on smartphones that might be affecting men versus women. But we've also seen some really interesting models where they've tacked onto existing structures and government plans, and that businesses have actually gone after specific government plans to reach women, and then added their services onto the end of those, and then achieved very good results as a result.
Okay, thank you very much. I would love to keep the conversation going, but we are at the top of the hour. For some of you, it's already late. So I want to thank everyone so much. I think what we've concluded in the conversation is that these digital models really do work. They can be a powerful tool for expanding financial inclusion. They can be so for both men and women, and help to overcome gender gaps, even if they're no silver bullet, but we clearly see the potential there. And that mission matters, that organizations that have an explicit financial inclusion objective that deliberately try to serve poor customers and women can do that very successfully with these approaches, but also that the companies that don't have those objectives can actually help to close financial inclusion gaps quite significantly. They might not do it for poor people, but they're still adding a lot of value in terms of expanding financial access, control, and well-being for lots of people. So very exciting data, fantastic conversation. Thank you to all of our panelists so much for joining. Thank you to our audience for tuning in as well. Please don't forget, this is the second in a series of 4 webinars that we are doing. The next one is coming up next week and is about the funding landscape for fintech. The 4th one is coming the week after that on the regulatory aspects of all of these profound changes to financial services. So please do sign up and tune in for those sessions as well. With that, thank you very much to all, and goodbye for now.
Thank you.
Thank you.